So let's talk about a little bit how we're positioning the portfolio as we go forward here. And we had a number of client questions that came in, so we'll talk about those first. The first one is, with the recent controversy surrounding large tech companies, does it change your bullish view of the tech sector or make you feel differently about being overweight? So really what they're talking about here is companies like Facebook with issues over privacy of customer data, companies like Amazon, concerns over them being a monopoly, and other companies like Twitter with concerns over privacy of data and everything. And in the US and Europe, some of these concerns are real, right? It's definitely something that we're watching as these companies become more regulated. It could impact growth here in the US, over in Europe. But when we saw this with Microsoft back in the 90s. But the thing to remember with these companies, a lot of the future growth that we're going to see is in other areas of the world, right? So these companies could continue to grow even if they face some regulatory challenges here in the US or overseas as well. The other thing is, when we're overweight technology, we are overweight these big companies, but we are also overweight in an ETF that is equal weighted. So that ETF, even the biggest companies have the same weight as the smallest companies. So in that ETF, those smaller companies will have just the same amount of pull or push as the bigger companies. And so again, we are overweight technology, but from our perspective, we want to be broadly overweight technology. And these concerns, we don't want to minimize them. We think they are, real concerns, but we still think that these companies can grow over time. These other questions I'll kind of answer in the rest of the presentation. What do you think of the short and intermediate term prospects for international investments? What changes are being made to minimize portfolio loss with the constraints of individual risk tolerances that could be a benefit moving forward? And every time there's a downturn in the markets, investors are always advised not to panic and let the market correct. What would be the best time, not necessarily to panic, but to get some level of concern? And then finally, do you plan to move some of the equity investment elsewhere to minimize the impact of a bear market and take advantage of a bear market by buying back at lower cost? And if so, what are the triggers? So all really good questions here. So let's talk about the portfolio adjustments that we see as we go forward. So as Ryan talked about, we're not seeing any recessionary situation that exists right now or even in the immediate future. But we are seeing some concerns. So we want to be prudent as we manage the portfolios. And what we want to be able to do is protect if there is more of a downside issue that comes up, but also be able to take advantage of this good economy that we're still seeing, because we still view that this bull market's going to continue. So the changes that we're going to be making, we're going to go slightly overweight into bonds in a very high quality, short-term fund, and we're going to be underweight equities. So that's a move that you're going to be seeing us make shortly here. We're going to be selling out several of our tactical positions that we've had in the portfolio that have done very well year to date. These are companies that have come out very strong from the year in January. And these are probably positions that we'll sell to capture some of that gain. When we do that, we're going to reallocate some of these funds to a dividend-paying ETF, right? So from our perspective, these are very high-quality companies that provide a dividend and also have opportunity for future growth. And then, as I mentioned, we're going to be reallocating to a short-term bond fund for tactical purposes. So what this bond fund is, it's going to protect more so on the downside if we do see any downward pressure. But if we do see that downward pressure, we could very well use this money to buy into that weakness, right? So that's something that we could utilize to buy if we think that the market prices are worth it if we do see the market move downward. So let's talk about the portfolio allocations. Right now, we continue to be overweight small cap companies. We're overweight technology, but as I described some of those changes, we'll be reducing that overweight slightly, but we will still be overweight in technology. We're overweight in healthcare, which has been very beneficial. And from our perspective, this is a growth opportunity as well as a defensive play, right? And that you're seeing that right now in the healthcare space. And we're increasing our allocations, I mentioned, to dividend paying and a value allocation. And I'll go into a little bit what that means by a value allocation in the portfolio. So let's talk a little about small cap stocks, right? So these are companies that are under $2 billion in size. They tend to have very high growth possibilities. Last year, they were in a bear market, and that means they were down by more than 20%. What this graph shows you is that since 1980, there are different times where small caps have gone into a bear market. But in every case, except for in 2008, the next year they were positive. And the average increase was 19.4%, right? So from our perspective, small caps can be a real value to the portfolio this year. Year to date, they're showing that right now. In particular, with some of the issues that we're seeing in global trade, these companies are really more focused on U.S. economy. So they may be a little bit more immune from some of the trade issues that the larger companies are seeing. So I talked about us moving a little bit more to what's called a value tilt with the portfolio. And what that means is, in general, we're talking about two different investment styles. Value means an index has more companies that are at a discount to their future cash flows. And there's a reason they're at a discount. There might be something going on in the company that you're buying them at a discount. Growth is just the opposite, right? You're going to be paying more for that company, and you're willing to pay more because the future earnings are that much stronger, right? So growth companies are your Apples, your Facebook, and value companies that are, again, selling at a discount relative to what their future cash flows are. Well, if you look at this, from 2000 to about 2009, value outperformed over that time period. And then from about 2010 on until now, growth has outperformed. Our portfolios have been strongly overweight to growth, which has been advantageous. But you can see we're starting to get back down to kind of that middle line right there, which is where it's kind of equal between value and growth. And we want to start to move a little bit more towards having a larger allocation to value in the portfolio, because we could see a situation like we did in the 2000s where value outperforms. So we're currently underweight international equities, and we've been in that allocation and that underweight for some time now. And there's a number of reasons, right? The uncertainty because of global trade, the Brexit uncertainty, which is going to be coming to a kind of a forefront in the end of March, Italian banking concerns that continue to exist, even the German economy, which has been a real engine of economic growth over in Europe, is starting to see some weakness. The yellow vest protesters in France, not really necessarily an issue with that economy, but it's really showing this element of nationalism that we're seeing in a lot of different countries. And what that means is that really limits international trade, right? So that type of situation could continue to exist in other countries, as you're seeing in France. And then even in Canada, we have some concerns with real estate values over in Canada. So as we look from a global perspective, right now we have really no allocation to the developed international, and these are the main reasons why we don't really want to have that in the portfolio and why we've been underweight for some time now. But we do have an international allocation, so the question is why? First of all, values right now, right? So in emerging markets, this chart basically shows values since 1999, and that dotted line is the average value versus US stocks. So relatively speaking, emerging market stocks are below the average versus US stocks. So what this means basically, they're relatively speaking a good value. But that's not the real reason why we want to hold them. This is one of the main reasons, right? So what this is looking at, that purple line there, that is the growth of emerging market stocks since 1997. The gray line that's underneath there, that is the growth of the GDP for developed countries. And you see that difference, right? Emerging markets have been growing anywhere from 3 to 5.5% over that time frame, while developed countries are more 3% and under, right? That strong growth, that's where you want to be investing. And US companies are doing a lot of selling into those countries, but we also want to own companies that are based in those countries as well. And the question is, will this continue? So I think this slide really tells that story, right? This is looking at the growth of the middle class, and it's looking at 3 different time periods. From 1995, which is the gray bar, 2018, which is the purple bar, and then the forecast for 2030. So let's just look at India and China, right? India, in 1995, only 1% in the middle class. By 2018, 14%. Look at where you're going to be, 79% in 2030. Think about all those people that are moving from agrarian society into middle class, and now they're consumers, right? Ryan mentioned in the US, 75% of GDP is from consumer purchases, right? This is what you're seeing in these emerging markets. China, the same thing, 0%. 0% of the country was middle class back in 1995. Now we're at 34%, expected to go to 72%. From our perspective, both for U.S. companies and when we're talking about foreign companies, this is the place where you're going to see economic growth from a global perspective. Let's switch gears and talk about bonds, right? So as Ryan mentioned, in the first part of last year, they were the hated asset class. By the fourth quarter, everybody appreciated having them in the portfolio. So with bonds, it's important to be a long-term investor, just like it is with equities. So in our portfolios, we have very high-quality bonds that have very short maturities, right? So we want very short maturities because if we do have rising interest rates, those bonds will do better. They'll have less of a downdraft than bonds with long maturities. We want the high quality because, if you go into an economic uncertainty, we want that to be rock solid, right? We don't want those values to go down anywhere near what equities will. And this graph kind of helps also enforce that idea. So what this is looking at is what's called investment grade bonds from 1994 to 2018. The blue part is what's called triple-B bonds. Now, those are the bonds, they're still investment grade, but they're right on the cusp, right? Those are companies that if there's a bad economy, they can move down to junk status, and the value of those bonds can decline quite dramatically. What you're seeing is from 1994, where it was a very small percentage, to where we are now, there's more of those triple-B companies, right? So we want to make sure that we're more, not in the triple-B range, we're up higher in that realm. And again, we don't think, especially with interest rates as low as they are, that there's any real economic concern or any real concern with these companies refinancing, but it's something we want to be cognizant of. We want to make sure, again, in the portfolios, the fixed income is a real rock solid element that's going to do well even in a downturn, and that's what we saw in the fourth quarter. All right, some questions to consider and things to remember. We had a few client questions here as well. If a client is no longer making active contributions to one's portfolio, would that warrant a reevaluation of risk, which is a great question. And I'm in retirement with the market volatility. Should I reduce my spending? Again, I'll be answering these questions in this section that we'll go through. So these are some questions you should be asking yourself. First of all, are you retiring in the next 2 to 5 years? If you are, this is potentially the time to be considering reducing your risk, right? And really what I'm talking about here is if you're in a growth or an all equity allocation, this might be time to scale back. If you're in what's called a 60-40 or growth in income, that's really where a lot of our retirees are, right? Because it's very important to have that equity allocation for growth. So it depends on where you are and your comfort level with risk, but we're still just down 10% from the market highs. This is not a bad time to potentially make that adjustment depending on where you are in your life and if you're getting closer to retirement. So what was your comfort level of risk for the fourth quarter? And you have to ask yourself this question because, if the fourth quarter made you really settled and you just were not sleeping well at night, it might be worthwhile, coming in and talk with us and at least reassessing. Either you're watching too much CNBC or Fox News business, or you maybe have too much risk in your portfolio. So, this is a good time and now even to consider is the right risk allocation. The flip side of that is if we do see the market go down and you're younger, you're still accumulating, it might be the time to become more aggressive, right? So, in those market fluctuations, those are the times to go ahead and make changes. So it depends on what your circumstances are and where you stand in life, but, we want you thinking about this during these times. Are you currently contributing to a 401k plan, right? So if we have people in there who are contributing, this could be a good time as the markets are down to actually increase your allocation to equities, right? Take advantage of that and buy into more equities with the depressed prices. Do you have cash to invest, right? This, again, we don't know where this market is going to go from day to day, but right now we're down 10% from the highs. If we continue to see more market volatility, this is a decent time, if you're a long-term investor, to get that cash to work. Do you need to raise cash in the next 12 to 24 months? Again, something to consider. This is not a bad time if you need cash for something in the next 12 to 24 months. The other thing I want to stress here is in the portfolios, even in the growth allocation, we still have an allocation to bonds that we can free up cash for you even if the market's down, right? So there are ways we can go without having to sell equities in a depressed market. But Right now, with the markets back up from their lows, not a bad time to consider, hey, if I need cash needs in the next 12 to 24 months, do I want to raise some money? Just also want to kind of bring this to your attention. We sent this out in an email, but across the traditional Roth IRAs, simple IRAs, 401k and 403bs, and individual 401k plans, those limits have gone up for 2019. So it's just something to be aware of, and again, we can have a conversation with you regarding your specific situation. Do you have a financial plan in place, or if you do, has it not been updated in the last year or so? So really would stress everyone out here to make sure you have a financial plan in place, and if you don't, come on in and talk with us. We'll get one in place for you. Or if it's been a year or two since we've updated it for you, I would suggest over time here that we have you come in and we update it, right? This is the crux right here. The market volatility is going to come and go. You have to always ask yourself, how is my financial plan? Is it in a state that I can survive that market volatility, right? And that's really where it's going to give you a level of comfort. And to that question that was asked, should I reduce my spending? No, you don't necessarily have to. If your plan is solid and you're in a good position, and we can go through that with you, there's a really good chance you won't have to reduce your spending at all. But that's where that financial plan, that's what gives you the peace of mind. When you know that, hey, I'm in a good spot. Even with this market volatility, I'm in a situation because of the way I'm invested and how I'm spending, that this really doesn't matter anything to my long-term financial plan. And then finally, with anybody who's taking a distribution from their account here with us, we carve out 2 years worth of distribution and put it in a more conservative allocation, right? So the average bear market, as Ryan mentioned, is 14 months. That will get you through pretty much any average bear market, and even with that 2 years, will get you through even an 08 situation. So this, again, allows anybody who's taking distributions not to have to reduce their spending, right? This is what gets you through without having to sell equities. This is very important to anybody who's taking distributions. So one last thing I want to just talk about here is, when you see this volatility, there is this general sense to become more conservative. And, at the end of the day, if it ends up being the right decision for you, then it's the right decision, right? There is no right or wrong decision as far as risk tolerance. It's an individual thing. But the one thing I want to talk about is the importance of equities for long-term growth. And what all this is showing is, if you're taking a 4% distribution out of $1 million portfolio, and the green line is you're all in cash, guess what? In 25 years, you actually run out of money. If you're in a 20-80 portfolio, so only 20% equity, you are pretty close to run out of cash in 30 years. It's not until you go to a 40-60 or a 60-40 where you really get that extra cushion, right? And this goes counter to what many people think. They're like, oh, well, I really want to make sure I don't run out of money, so I'm going to become really conservative. It's just the opposite. And here's an important point to note, too, which is back 25 years ago, when interest rates were 7, 8, 9%, yeah, you could get a CD, and you could actually, the old adage was, depending on your age, that should be your allocation to bonds or CDs. Well, it doesn't work these days, right? When, inflation's only 2%, you need to have equities in your portfolio to have that growth, to be able to provide that cash flow over a long period of time. It's very important not to be afraid of any of the short-term volatility, but understand with equities, it gets you the growth that you need to have.